All right, well, we got that inflation data this week that suggested that we are seeing some cooling price pressures in this country. And as a result, we've got bigger expectations for a rate cut in Canada. Right now in the market, there's an expectation that we could see a rate cut as soon as June, more than 60% odds of that. In the U.S., nobody's expecting, basically close to nobody's expecting anything like that to happen in June. But as we get later into the year, there are some expectations. We'll see a catch up in the United States as well. Let's get some insight and analysis now from Karl Schamotta, Chief Market Strategist at Corpay. Karl, nice to see you.
You as well.
So the inflation data yesterday increased expectations around a cut for Canada next month?
Most certainly. We do have inflation running essentially in the Bank of Canada's target band. We have most core measures showing clear signs of subsiding. And once you take shelter out of the equation, inflation's well under target. So, traders have moved to incorporate a June rate hike rate cut, in the forecast. However, it is kind of interesting right now. Traders are absolutely not certain that June is going to happen. It could be July, right? The first rate cut is really fully priced into the curve for the July meeting.
What's the determining factor, do you think, outside of all the data that we've got in front of us? Or anything else you think the Bank of Canada is going to look at before they make that decision?
Yes, I think the economy itself, right? So we do know that inflation is subsiding, but we have seen signs of a melt up in the economy itself. Employment conditions appear to be improving. We know that we had a first quarter gross domestic product print that was above expectations and certainly above what the Bank of Canada itself expected. And then, of course, you have the global spillover effects, right? The fact that the U.S. economy is still performing as well as it is helping to lift spirits here in Canada. So, if we see continued improvement in the Canadian housing market and we see that data kind of come in and paint a positive picture for the Canadian economy, we could see the bank really wait until that July meeting before they pull the trigger on easing. And
does the fact that the U.S. is still further away from rate cuts complicate matters for the Bank of Canada?
I don't think so. I think Tiff Macklem said in his last testimony that the limit is far away at this point. Essentially, the big core sort of issue here is that the pass-through of low currency exchange rates through to inflation is very, very limited in Canada. When we look back at history, it would take a very, very big move, a 10% very sudden, very aggressive decline in the exchange rate to really impact inflation here in Canada. And so there is quite a amount of room for the Bank of Canada to sort of strike on a divergent path. And I think the core thing to understand right now when we look at markets is that markets have expected this for months. The reality is that, we've expected this faster, more aggressive easing cycle from the Bank of Canada for months. That's been incorporated in the exchange rate. And now the question is what happens to the U.S. economy? If we see the U.S. economy slow, that is going to change, all the dynamics as far as the exchange rate is concerned.
So at the end of the day, what are your expectations for what Canada and the U.S. do by the end of this year?
By the end of this year. So I do think the Bank of Canada will pull the trigger at the July meeting. I do think they are going to wait a little bit before they do so. I think they will deliver rate cuts, probably 2 before the end of the year, not at back-to-back meetings. So I think you're going to see a rate cut happening at the same time as they're kind of cautioning against expecting this easing to accelerate. And in the U.S., I would expect 2 rate cuts as well. The question there is whether they get one out of the way at the September meeting and then wait until December, or if they sort of, time it to land right around the election.
What does that mean? What does all of that mean for the Canadian dollar, in your opinion?
Fun things for the Canadian dollar. So, I'm pretty skeptical of calls right now for the Canadian dollar to drop to like 70 cents. I think that's overshooting quite a bit from where we are today. But I would think that, given the speculative pressure that's been building up in the market, that the Canadian dollar is going to come under more near-term selling pressure. Just going into that first cut, that tends to happen, even though we know it's, relatively certainly well priced in. The reality is that once the retail traders get involved and start pushing the Canadian dollar down, it can tend to overshoot, right? However, if we do see hotter than expected data in the coming 2 months, very, very likely that we see a rebound off those lows, and that that brings us down to perhaps the 75-cent range. So between that and the longer term bearish view on the Canadian dollar, in other words, the long term exposures that we have in the Canadian economy to high interest rates, we are looking at a pretty volatile period ahead. It's not going to look like last year did. Last year was way too quiet for my liking. And
the argument that the weaker Canadian dollar then means we'll import inflation from the United States, how do you feel about that idea?
I don't think that that's a strong factor at all. So yeah, like the exchange rate pass through has fallen dramatically in all industrialized countries over the last couple of decades. The reality is that prices are now set on global markets and driven largely within economies themselves by domestic service costs, right? And so inflation will potentially rise a little bit if we do see a big, profound decline in the Canadian dollar. But it is not likely to blow the doors off in any way, shape, or form. And so I think at the end of the day, the big thing that we all have to really look at is just the economy itself, right? And the vulnerabilities that we're seeing in the economy show up, right? I know for the last year, or really last couple of years, myself and virtually every other observer in Canada was suggesting that we'd eventually see some weakness coming from the Bank of Canada's tightening cycle. I think we are beginning to see that really show up, certainly in unemployment rates and in per capita GDP. And so, fundamentally in the long run, the direction for Canadian interest rates should be lower, and the Canadian dollar should remain on the defensive relative to the US dollar.